Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy live trading room. Special alert for August 10, 2021. Have interest rates bottomed? When we take a look at the 10-year note, trading last at 134 in the quarter, up 2.5 basis points, up 1.91%. We're beginning to see that the market has come back up from a low that was made this week of 112 on the 10-year note. We've been tracking the 10-year note very closely to see the move of interest rates short term by the direction of the 10-year note on the short end of the curve. And what we see in here is that the yield on the 10-year note has risen from 112 to 134. That's a pretty substantial amount, again, in a short amount of time. And what we have seen is a great deal of volatility in the gold market, which has essentially brought the price down into that 1730 area trading right now and has come down as low as 1731.60. The low of 1677.90 was made on August 9th, which was yesterday. What the 10-year yield has done is essentially alert the possibility that interest rates are on the way up. And short term, it has given the mentality or the nervous investor a reason to sell into precious metals, gold and silver in particular. And one of the reasons why I'm concentrating very much in this monetary instrument is simply because of the monetary policies that are being implemented, that have been implemented as a consequence of this pandemic that we saw as of March of last year. There is a lot of mixed emotion about the economic recovery that we're getting. A lot of positive talk about coming back to a normal economy, strong economy, a lot of demand, but we have a real mixed up economy in that the expected results or consequences of the pandemic were completely misguided, completely the opposite. Most people were afraid that real estate prices, for example, were going to collapse. The stock market did collapse, but it regained composure in a short period of time, and it basically discounted what we're looking at, which was essentially the transition into the digital economy that has been pretty much now predominantly taken the attention of major investors, and basically a lot of capital has moved into the digital economy. The fact that the stock market ran up since last year after the pandemic collapsed was discounting that essentially we were moving into a digital economy. And as you can see now, the market, basically the Amazons of the world, the Walmarts, the Costcos have taken pretty much the control and have monopolized basically the sectors, particularly the digital economy. The move was anticipated on the basis that the amount of stimulus that was required by the economy was going to weaken the dollar, is going to cause an inflationary spike, which in fact we're beginning to see. And we're going to see just how much this spike, this inflationary spike, is going to affect us as we have the Consumer Price Index report coming out at the end of this week. The question is this inflationary transitory? Or is it part of a new change in paradigm in the value of the underlying asset in the U.S. markets? And that underlying asset is basically the U.S. dollar. So the fact that assets have increased, real estate, crude oil, the stock market making new highs, is simply a reflection of the weakness of the currency underneath those assets. And you want to be clear in your mind in terms of the real return that you're getting on your assets, because if you account for the devaluation of the US dollar as part of your profit and loss results, you're going to realize that you're really not making the money that you think you're making, or the profits that you think you're making, because the underlying currency is being devalued. And so what's happening basically is that you're barely breaking even, and depending upon the asset that you're in, whether it's real estate or whether it's stocks, are going to determine the true real return when you factor in the inflation. For example, if we're getting on the 10-year note right now 1.34 yield, and inflation is running at 5.4%, then you're looking at a negative inflationary real return of -4.5%. That's a phenomenal loss of purchasing power in the currency. That is, I believe, the silent transfer of wealth that is occurring in the US dollar. And you can see the smart money basically anticipated this and moved into real estate, into other assets that at least would break even with inflation. So the danger that we have moving forward basically is, how fast is inflation going to accelerate in relation to the real rate of returns that are being offered right now? And when you take a look at the U.S. yield outside of Australia, which is about the same yield, are about the only countries that are offering positive yields. But factor into account the currency devaluation, and we're talking about a whole different ballgame that we need to address. Commentary. As we take a look at the possibility that inflation is going to increase and accelerate particularly as we get negative interest rates, real negative interest rates accelerate. There are very few areas where you can get value, where you can get yield. And if you take a look at every other asset in comparison to gold and silver, you begin to see a tremendous anomaly where the metals are trading at a discount to just about every other asset in the world. And it's just a matter of time before we see the reversion to the mean take place and price discovery adjust to the real price of gold, which is substantially higher than where we are right now.
Are you looking for an automated artificial intelligence trading system? Do you want to analyze commodities and financial markets to determine when to buy and sell? Looking for an indicator to predict future trends in the commodities and financial markets? Welcome to EMA2 Trade Live Signals. Our Variable Changing Price Momentum Indicator, VCPMI, is an automated AI trading system developed and tested over a decade. The VCPMI algorithm is based on age-old vortex mathematics combined with Fibonacci wave theory, trend analysis, pivot points, and several other widely accepted financial analytical methods. The VCPMI can help you take emotions out of your trading and rely on simple mathematics to predict future trends in financial markets. This approach will make your trading more effective, consistent, and profitable. VCPMI algorithm. The VCPMI code points and levels are support and resistance levels and behave exactly like any historical supply and demand level. Therefore, the VCPMI code levels are useful as an index tool for both day trading and for selecting and exercising entries and exits for longer-term traders. Why VCPMI? The VCPMI relies on artificial intelligence to analyze markets and predicts future movements, which seek to determine what a security or commodity is worth at a given point in time. The VCPMI uses technical analysis in the form of mean reversion trading, which seeks to capitalize on extreme changes in the pricing of a particular market based on the assumption that it will revert to its previous state. The VCPMI can be applied to both buying and selling, as it allows a trader to profit on unexpected upswings and save when security or commodity is trading at an abnormal level. Visit EMA2trade.com for more details.